Is the Vanguard S&P 500 ETF a buy right now? Let's talk about one of the most widely owned investments on the planet, the Vanguard S&P 500 ETF, ticker symbol VOO. If you already own it, you're probably wondering whether you should keep adding. If you don't, you're likely asking the same question everyone asks when markets are near highs: is now a smart time to buy, or am I walking in at the top? Today, we're going to break this down clearly. No hype, no fear tactics, just the facts, the risks, and what actually matters for long-term investors. The Vanguard S&P 500 ETF tracks the S&P 500 index, which represents 500 of the largest publicly traded U.S. companies. Think Apple, Microsoft, Amazon, Nvidia, Alphabet, and hundreds of others across technology, healthcare, finance, and consumer sectors. It's designed to be a broad snapshot of the U.S. economy, not a speculative bet. As of early 2026, VOO is trading near all-time highs, and that's where the debate begins. One of the main concerns right now is valuation. The S&P 500's price-to-earnings ratio is sitting well above its long-term historical average. In simple terms, investors are paying more for each dollar of earnings than they typically have in the past. That doesn't mean a crash is guaranteed, but it does mean expectations are high. So why are investors still buying? The first reason is earnings growth. Analysts continue to project solid revenue and earnings expansion across many S&P 500 companies. Corporate balance sheets remain strong, margins are holding up, and productivity gains, especially from automation and AI, are supporting profits. As long as earnings keep growing, higher valuations can persist much longer than people expect. Second, the quality of companies inside the ETF matters. VOO is not filled with speculative startups. It's dominated by highly profitable, cash-generating businesses with global reach. These companies tend to weather economic slowdowns better than smaller or more leveraged firms. That doesn't eliminate risk, but it does provide a degree of resilience. Third, interest rates play a role. Markets are forward-looking, and many investors expect the Federal Reserve to gradually ease rates if inflation continues to cool. Lower or stable rates generally support equity valuations by making future earnings more valuable in today's dollars. This is one of the quiet tailwinds supporting the S&P 500 right now. Now, let's talk about the real risks, because they are not imaginary. The biggest risk is concentration. A significant portion of the S&P 500's gains has been driven by a small group of mega-cap stocks. If those leaders stumble, the entire index can feel it. This means VOO may be more volatile than it appears during periods when leadership narrows. Another risk is macro uncertainty. Economic growth could slow, inflation could re-accelerate, or geopolitical events could disrupt markets. Any of these could trigger a pullback, especially when valuations are elevated. So, is VOO a buy right now? The honest answer is it depends on your time horizon. If you are a long-term investor with a 5, 10, or 20-year outlook, history strongly favors staying invested. Trying to time the market has consistently produced worse outcomes than steadily investing through highs and lows. For these investors, dollar-cost averaging into VOO remains a rational, disciplined strategy, even at higher valuations. If you are investing money you'll need in the next 1 to 3 years, this is a different conversation. Short-term market swings matter much more, and buying at elevated levels increases the risk of disappointment if markets pull back. One thing that often gets overlooked is cost. VOO's expense ratio is extremely low, around 0.03%. Over decades, that difference compounds into real money staying in your pocket rather than going to fund managers. This is one of the strongest arguments for using a broad Vanguard ETF as a core holding. So here's the bottom line. The Vanguard S&P 500 ETF is not cheap by historical standards, but it is supported by earnings growth, high-quality companies, and favorable long-term economic fundamentals. It may not deliver explosive short-term gains from here, but as a foundational investment, it continues to do exactly what it's designed to do: provide diversified exposure to the long-term growth of the U.S. economy. For disciplined investors, the question is not whether VOO is perfectly priced today. The real question is whether you believe the U.S. economy and its leading companies will be larger, more productive, and more profitable 10 years from now? If the answer is yes, then VOO still earns its place in a long-term portfolio.